If I told you that the financial system we live in today, the one where trillions of dollars in debt seem to rule our lives, was never a mistake or an accident? It's not a crisis that needs solving. It's a system, carefully constructed over centuries, and it's working exactly as designed. Governments across the globe, yours included, are trapped in a cycle of debt that can never be broken. And it's not just the United States. Every country, from the richest to the poorest, is caught in this trap. The global debt currently stands at a staggering $315 trillion, 3 times the size of the entire global economy. But here's the question. If everyone owes money, who exactly are they owing it to? The answer is simple, yet terrifying. The money we owe isn't owed to some far-off creditor. It's a system where debt is transferred endlessly, where the interest payments keep flowing up, and where the very institutions that created the system keep profiting from every crisis, every bailout, and every dollar of debt that accrues. But this wasn't a coincidence. The 4 architects of this system, bankers from 3 centuries, designed it this way. They built a financial machine that ensured that no matter how bad the debt got, no matter how much the global economy struggled, the money would keep flowing to the same small group of powerful institutions, and it's too late to stop it now. The truth is, this system was set up so that it could never be escaped. The banks that created this trap made sure of it. You think we're in control of our financial future? Think again. We're living in the world they created, and we're not getting out. The story of how we got here begins long before our time, back in 1694. At that moment, an idea was born that would change the entire world. And it wasn't the kind of idea you'd expect from a merchant struggling to get by. It was a financial scheme, one that would slowly evolve into the massive debt trap we find ourselves in today. The man behind this idea was William Paterson, a Scottish merchant who was trying and failing to get rich. At a time when England was desperately seeking funds to support its war efforts, Paterson saw an opportunity. He approached King William III with a revolutionary proposal. Instead of borrowing money in the usual way and paying it back, England would borrow money and never repay the principal. Instead, it would pay interest forever. That's right, forever. The government would borrow £1.2 million from wealthy merchants, promising to pay 8% interest every year with no end in sight. But Paterson didn't stop there. He proposed the creation of a new institution, the Bank of England. This bank wouldn't just handle the loan, it would give birth to an entirely new way of managing debt. The idea was simple, but incredibly effective. Rather than repaying the loan, the government would pay interest forever, and the merchants would have a way of profiting from that interest. The Bank of England would issue paper money backed by government debt, allowing the debt to circulate as currency. Here's where Paterson's genius became clear. By allowing the government to borrow and pay interest without ever paying off the principal, he created a system where debt was permanent. This was the beginning of an idea that would be passed down through history, evolving into the global system of debt we are caught in today. But while it was brilliant for the bankers, it was catastrophic for the people. And the worst part? This system is still alive and well, spanning across the world, enslaving nations, and keeping the profits flowing to the same institutions. Fast forward to the 1800s, and we meet Nathan Rothschild, a man who would industrialize and globalize Paterson's debt system, cementing it as an unbreakable force in the world economy. At the time, the Rothschild family was already a financial powerhouse, but Nathan had a vision to take it further. By 1815, he had established banking houses in 5 major European cities: London, Paris, Frankfurt, Vienna, and Naples, creating an unprecedented network of financial influence. His strategy: control sovereign debt, and with it, entire governments. In the midst of the Napoleonic Wars, Rothschild became instrumental in financing Britain's war effort. But rather than just lending directly to the government, Rothschild revolutionized the market by creating a secondary market for bonds. He would buy government bonds at a discount, then resell them at a markup to other investors. This model turned government debt into a tradable asset. It wasn't just about providing money, it was about controlling the flow of capital and dictating the terms of debt. But Rothschild's brilliance went deeper. His manipulation of the bond market during the Battle of Waterloo is legendary. Through his fast courier system, Rothschild learned of Napoleon's defeat before anyone else. Armed with this knowledge, he sold off British bonds, signaling to the market that Britain was losing. The price of bonds plummeted and panic ensued. Once the news broke of Britain's victory, bond prices skyrocketed, and Rothschild purchased vast quantities at rock-bottom prices. In one move, he made millions. This was the birth of the modern debt system, where nations no longer just borrowed from wealthy individuals. They became tied to a global web of creditors. Rothschild had made sovereign debt tradable across borders, and governments now found themselves trapped. Defaulting on debt would no longer just affect one creditor. It would have ripple effects across entire financial networks. This system ensured that governments would always need to borrow more, and for those controlling the debt, the profits would flow endlessly. Now let's turn to the early 20th century, where a key figure in America's financial system, J.P. Morgan, played a pivotal role in solidifying the modern debt system as it exists today. Morgan wasn't just a financier, he was a financial kingmaker. In 1907, a financial panic shook the United States. The stock market crashed, banks failed, and the economy froze. But in the midst of the chaos, Morgan single-handedly organized a rescue mission. In his private library, he summoned the most powerful bankers of New York to pledge their own money to stabilize the banking system. And it worked. The panic was averted, and Morgan became the de facto central banker of America. But Morgan knew that one man couldn't do it forever. The banking system needed a permanent solution, and it was clear that a central bank was the answer. However, creating a central bank in America wasn't going to be easy. There had been bitter opposition to central banking in the past. The public was wary, remembering how the first and second banks of the United States had been shut down due to populist backlash. In 1910, a secret meeting took place at Jekyll Island, Georgia, attended by Morgan and a few powerful associates. There, they crafted a plan to create the Federal Reserve. It would be presented to the public as a decentralized system of regional banks with a government-appointed board, but in reality, it was designed to serve the interests of the banking elite. The Federal Reserve would control the money supply and have the power to buy government bonds, creating a guaranteed buyer for U.S. debt. In December 1913, the Federal Reserve Act was passed, and just like that, the debt system was given an unshakable foundation. The government no longer had to rely on foreign creditors or individual investors to finance its debt. The Federal Reserve could simply create money to buy bonds, ensuring an endless flow of capital. And with that, the debt trap was solidified. It wasn't just that the U.S. government could borrow as much as it needed, it could do so indefinitely. As the 20th century approached, the United States was experiencing rapid economic growth, but it lacked a central mechanism to manage its finances effectively. In the late 1800s, America's financial system was still relatively primitive compared to European powers like Britain. Banks were independent, the money supply was tied to gold, and there was no central authority to regulate the economy or control national debt. This created instability, and in 1907, a panic struck. J.P. Morgan, the titan of American banking, stepped in to resolve the crisis. By rallying major New York bankers to stabilize failing banks, Morgan effectively became the de facto central banker of the United States. However, he knew that this was not a sustainable solution. The country needed a permanent institution that could manage the nation's debt and financial system. In 1910, in a secret meeting at Jekyll Island, Georgia, Morgan and a group of influential bankers and politicians, including Senator Nelson Aldrich, devised a plan that would forever change the U.S. financial landscape. They created the Federal Reserve, a system that was sold to the public as decentralized and democratic, but in reality was designed to benefit the banking elite. The Federal Reserve System was not a central bank in the traditional sense. Instead, it was a network of 12 regional banks, with the Federal Reserve Bank of New York controlling the most significant power, the ability to issue money and purchase government bonds. The creation of the Federal Reserve effectively institutionalized the debt trap. It allowed the U.S. government to borrow without limit. The Federal Reserve could create money out of thin air to buy bonds, ensuring that there was always a demand for government debt. This system made it possible for the government to keep borrowing indefinitely without the risk of running out of money or facing default. As long as the system functioned, the government could continuously roll over its debt, and the interest payments would flow, primarily, to the banks that controlled the Federal Reserve. By the late 1970s, the debt trap was already well in place. But as inflation soared and global confidence in the US dollar began to wane, America faced a new crisis. Inflation was above 10%, and foreign governments were losing faith in the dollar. If something wasn't done, the system would collapse. Enter Paul Volcker, the chairman of the Federal Reserve from 1979 to 1987, who was tasked with tackling the inflation problem head-on. In 1979, Volcker took a dramatic step. He raised the federal funds rate from 11% to a staggering 20%. This aggressive interest rate hike was designed to kill inflation, but it also had significant unintended consequences, particularly for developing nations that had borrowed extensively in US dollars during the 1970s when rates were low. These countries, such as Mexico, Brazil, and Argentina, suddenly found themselves unable to service their debts. The cost of paying interest on their loans tripled overnight, and many of these countries defaulted on their obligations. But instead of allowing these nations to face the consequences of their borrowing, the US and international institutions, like the International Monetary Fund, IMF, intervened. Volcker orchestrated a massive bailout. These countries were lent enough money by the IMF to keep making interest payments to American banks. The debts were not forgiven, they were merely restructured. New loans were issued to prevent default, but the result was that these countries were now caught in a perpetual debt cycle. This restructuring of debt became a standard operating procedure. Instead of reducing or forgiving debts, the global financial system, led by institutions like the IMF, simply refinanced them, allowing the interest payments to keep flowing. This was Volcker's innovation. When debt becomes unpayable, don't forgive it. Instead, restructure it to keep the interest payments coming, ensuring that the financial institutions continued to profit. This set the stage for a global debt trap that to this day has ensnared not only individual nations, but the global economy itself. The mechanism for managing debt and extracting interest payments became embedded in the system, making it nearly impossible for countries to escape their obligations. Now that you've seen how the debt trap was constructed and how it continues to hold countries and the global economy captive, it's time for you to take control. This isn't just history. This is the financial system we all live under today, and it affects every decision we make, from the prices we pay at the store to the stability of our retirement funds. The question is not whether the debt trap is real. It's how long you can ignore it before the consequences reach you. Here's what you can do now. Get educated. Understanding how the system works is the first step to protecting yourself. Dive into resources about the Federal Reserve, sovereign debt, and financial history. The more you know, the better you can navigate the challenges ahead. Prepare financially. Don't rely on the system to support you. Start saving aggressively and consider diversifying your investments. The debt trap won't be a quick collapse, but it will create pressures on the economy over time. Be ready for inflation, rising interest rates, and potentially unstable markets. Stay informed. Keep an eye on global financial developments. Watch for signs of further tightening by central banks, debt defaults, and changes in currency dynamics. When a country starts to default, the ripple effects can be felt globally. Spread the word. Share this knowledge with others. People need to understand that this is not a temporary problem. It's a systematic issue built into the fabric of our financial system. The more informed the public is, the more pressure we can put on governments to start facing these problems head-on. This system isn't a mystery. It's a well-documented reality that many don't want you to see. But now, you know the truth. Don't ignore it. Take action. Plan for the future and protect yourself from the coming storm. This is just the beginning, and the more prepared you are, the better positioned you'll be when the global economy shifts. Subscribe to this channel for more insights on how the system was designed, how it operates, and how you can prepare for the challenges ahead. The clock is ticking, and understanding the machine is the first step toward making sure you don't get trapped in it.